When venturing into the world of stocks, it's essential to begin with a solid understanding of the concept of stock market investing. At its core, stock market investing involves purchasing shares or equities in a company, which grants you partial ownership in that company. As a shareholder, you have the potential to earn profits as the company grows and succeeds, typically through dividends and capital appreciation. The stock market itself is a collection of markets and exchanges where these buying and selling activities take place, such as the New York Stock Exchange or Nasdaq. Understanding the significance of stock market investing is crucial because it serves as a cornerstone for building wealth and achieving financial goals over the long term. It provides individuals the opportunity to participate in economic growth and innovation, offering potentially higher returns compared to traditional savings methods, such as savings accounts or bonds. Stock market investing empowers individuals to be part of the economic engine, allowing them to profit from the success of businesses. For instance, let's look at two real-world applications. First, consider someone who invested in Apple Inc. in the early 2000s when the iPod was gaining popularity. As Apple launched more innovative products like the iPhone, the company's stock value soared, significantly increasing the investor's wealth. Another example is an investment in index funds, which track broader market indices such as the S&P 500. This approach provides diversified exposure to the overall market's growth, lowering risks associated with individual stocks while capitalizing on general economic progress. However, stock market investing is not without challenges and controversies. It requires a good understanding of market dynamics and economic forces, which can be daunting for beginners. Market volatility and the unpredictability of stock prices can lead to substantial financial losses if not approached wisely. Critics argue that high-frequency trading and market manipulation can disadvantage individual investors. Additionally, there are alternative viewpoints, such as those favoring real estate or other forms of asset investment, citing that stocks can be too risky or lack tangible value. Despite these challenges, stock market investing is intricately linked to other financial aspects like personal finance management, retirement planning, and even entrepreneurship. A well-planned approach to investing in stocks can complement these areas, enhancing one's overall financial strategy. By understanding this foundational concept, investors can make informed decisions that align with their financial goals, contributing to long-term financial success. The dialogue between risk and reward in stock market investing is timeless, shaping investment theories and practices across decades. Understanding stock market basics is a foundational step in learning how to invest in stocks. At its core, the stock market is a platform where shares of publicly held companies are bought, sold, and issued. Stocks, also known as equities, represent ownership in a company and entitle the shareholder to a portion of the company's profits and assets. The stock market is driven by supply and demand, where prices can fluctuate based on various factors like company performance, economic indicators, and investor sentiment. The significance of understanding these fundamentals cannot be overstated for anyone looking to invest in stocks. Without a solid grasp of how the stock market operates, investors might find themselves making uninformed decisions that could lead to financial losses. Knowledge of market basics helps investors recognize the potential risks and rewards associated with different investment strategies, empowering them to make more calculated decisions. Real-world applications of understanding stock market basics include navigating stock exchanges like the New York Stock Exchange, NYSE, or Nasdaq, where millions of trades occur daily. For example, recognizing the role of market indices such as the S&P 500 helps investors gauge overall market performance and economic health. Another application is understanding the price-to-earnings (PE) ratio, a commonly used metric to Assess whether a stock is undervalued or overvalued, guiding investment choices. Some experts argue that a strong understanding of stock market basics is essential for financial literacy and long-term wealth building. They advocate for education on these topics as a vital skill for managing personal finances in today's economy. However, others highlight the complexities and inherent unpredictability of the stock market, suggesting that even well-informed investors can face challenges due to market volatility or unexpected economic shifts. Controversies surrounding stock market investment include debates over the effectiveness of active versus passive investing. While active investors attempt to beat the market by frequently buying and selling stocks, passive investors trust in market efficiency over time, often choosing index funds. This debate underscores the importance of understanding market basics to develop an investment strategy aligned with one's financial goals and risk tolerance. Basic stock market knowledge interconnects with other aspects of investing, such as risk management, portfolio diversification, and market analysis. By grasping these basics, investors are better prepared to engage with other concepts that contribute to effective investing. Overall, understanding stock market basics is a crucial part of becoming a successful investor and achieving financial independence. In the world of investing, understanding the different types of stocks is fundamental to crafting a successful investment strategy. Stocks, essentially shares of ownership in a company, can be broadly categorized into several types, each with its own characteristics, risk levels, and potential returns. Common stocks and preferred stocks are the two primary categories. Common stocks grant shareholders voting rights and the potential for dividends, though dividends are not guaranteed. They are the most frequently traded and are known for their growth potential. On the other hand, preferred stocks typically offer fixed dividends and have priority over common stocks in the event of bankruptcy, but they usually do not confer voting rights. The significance of understanding these types rests in tailoring a portfolio that aligns with an investor's financial goals and risk tolerance. For example, younger investors with a longer time horizon might prioritize common stocks for their growth potential, while those nearing retirement may lean towards preferred stocks for stability and regular income. Apple Inc. serves as an example of a common stock that has provided substantial growth over the years, rewarding investors with capital appreciation. Conversely, a company like Procter& Gamble may offer preferred stocks that appeal to more conservative investors looking for steady dividends. Opinions in favor of diversifying across different stock types highlight the balance between risk and reward that this strategy can achieve. The growth potential of common stocks appeals to those seeking capital gains, while the regular income from preferred stocks attracts income-focused investors. However, challenges arise in the form of market volatility and the potential for misjudging a company's financial health, which can result in significant losses. Additionally, preferred stocks, while more stable, may underperform in terms of growth potential, and their fixed dividends might not keep pace with inflation over time. Alternative viewpoints suggest that some investors might prefer to forego individual stock selection entirely and opt for index funds or ETFs that inherently diversify across various stock types. This point of understanding different stock types is intrinsically connected to broader investment strategies, like risk management and asset allocation. It influences how investors diversify their portfolios, decide on investment timeframes, and manage financial risks. Ultimately, knowledge of the different types of stocks empowers investors to make informed decisions, aligning their investments with their long-term financial objectives and risk tolerance levels. Developing an investment strategy is a critical step for anyone looking to invest in stocks, as it provides a roadmap for making informed decisions in the complex world of stock markets. An investment strategy outlines the rules, behaviors, and overall approach that a person intends to follow when investing. It is tailored to an individual's financial goals, risk tolerance, time horizon, and personal circumstances. This strategy helps investors stay focused and disciplined, preventing emotional reactions to market fluctuations that can lead to poor financial decisions. The significance of developing an investment strategy cannot be overstated. It serves as the foundation for successful investing by aligning decisions with long-term objectives and ensuring that investors have a systematic approach to market opportunities and risks. Without a strategy, investors may find themselves swayed by short-term market volatility or succumbing to impulsive decision-making, which can lead to significant financial losses. Two real-world applications of investment strategies include buy and hold and value investing. The buy and hold strategy involves purchasing stocks with the intent of holding on to them for an extended period, regardless of short-term market fluctuations. This approach is based on the belief that over time, stock markets tend to rise. On the other hand, value investing focuses on finding undervalued stocks that are trading below their intrinsic value. Investors using this strategy seek to capitalize on stocks that they believe are currently undervalued by the market, expecting their prices to eventually reflect their true worth. Proponents of investment strategies often emphasize their ability to mitigate risk and provide a structured path to wealth accumulation. Many financial experts argue that sticking to a well-thought-out strategy can enhance investment outcomes compared to ad hoc stock picking or attempting to time the market. However, there are potential challenges associated with developing an investment strategy. Market conditions can change rapidly, and a strategy that works well in one environment may underperform in another. Additionally, there are differing opinions on which strategies are most effective, and some critics argue that a rigid strategy might lead to missed opportunities or insufficient adaptation to new trends. Developing an investment strategy is closely connected to other aspects of investing, such as risk management and portfolio diversification. A well-defined strategy typically includes guidelines on how to manage risk and diversify investments to achieve a balanced and resilient portfolio, thereby influencing overall investment success. In essence, a robust investment strategy is an essential part of a comprehensive approach to investing in stocks, helping individuals navigate the complexities of the market effectively.